Good morning, everyone. Welcome to this update for global stocks and commodities for the 11th of March. The title of this week is that momentum trounces news, and there's a couple of aspects to that. As you're aware, in early February, we had a correction. Things looked pretty nasty, and it really did, I guess, put a lot of people offside in terms of what the market was doing. You may recall a couple of weeks ago, the headline was that the correction is complete, and I certainly copped plenty of comment and a bit of flack over that headline. But I want to make a couple of really important points about that in this video. But certainly Friday night was very strong in the US. It was supported by just another really almost ideal set of economic circumstances, which is, not too good, not too poor, just right in the middle, and it's creating the environment where stocks can just continue to rise. So I think that was certainly, if you didn't need any more confirmation that the correction was over, then certainly Friday night provided that with the US jobs report. So let's jump into this particular update because there's some really important messages that I want to get across, and that's really the purpose of these weekly videos, which I've been doing now for nearly a decade. I've learned a lot of lessons over my 3 decades in the market. I was a bit slow to learn them. Probably didn't learn terribly much in the first 10 years, but certainly since then I've learned some tremendously valuable lessons, and my objective through these weekend videos is to pass those on to you so that hopefully you can get to a better trading and investing place far more quickly than I did. So let's take a look at what's in this update. The market sentiment has shifted quickly again. It was incredibly positive. It was just too positive in January. We then got the correction we had to have in early February, but that played out in the matter of just a few days, and the market has gone from reacting quite badly to any little bit of bad news to now it's pretty much ignoring the bad news and it's just going up anyway. So sentiment has shifted back again very quickly to what we saw last year. So following the tape, if I can use that expression, so being able to read the charts is just so much more profitable than trying to pin your hopes purely on fundamental analysis. There's nothing wrong with fundamental analysis. It's valuable and it has its place, but not without being able to read the charts as well. And it's certainly far more important than the news and all the political noise that's out there. What did Trump say? What does he mean? What's he going to do? It's all pretty much irrelevant for the market when you get past the impact of just a couple of days. So I'll be looking at the stock and commodity trend update, of course, and portfolio analyst last week did a bit of a recap on some emerging opportunities and some Australian resource stocks. So that wasn't a bad session last week. So let's jump in and have a look at what happened in the American market. The S&P was sharply higher, 95 points, nearly 4% up. That's a big week by any stretch of the imagination, and quite a lot stronger than the Australian market. So clearly this period from early February has now given us the clear indication that this is just a pause and it's not remotely like a top. So that's all it will be, and I think it validates my position that we will enter a period which will probably be volatile for a period. We may go sideways, we may set new highs, I don't know, but we'll almost certainly set new highs by the second half of the year, but perhaps sooner. So new highs could come sooner rather than later, the way the market is looking, and particularly with that economic outlook and report on Friday night. And I suppose the the point you've got to remember is that long periods of strength, as we've seen, the market has really been very, very strong since January, February of 2016. Those long periods of strength don't just disappear overnight, and that's why as soon as the market sentiment shifted, the strength in the market just came roaring back again. The economic fundamentals are pretty close to ideal. They're not too hot, not too cold. They're just sort of right in the middle, and stocks can just get on and do their thing. And I must say that sentiment certainly did get punctured during that correction last month, and sentiment is still pretty poor when you look at the various investor surveys that they run in America. And sentiment is far more like a market low and not a market top, and that's a good sign, because when it comes to sentiment, you definitely want to be a contrarian. When sentiment is poor, and people are nervous, that's when you want to be really looking hard at the opportunities. When everybody's bullish and everybody feels the market can just keep going up and up, as we saw during January, then it's getting pretty dangerous. So always try and be a contrarian when sentiment is involved. Now, I just want to make the point, and this is really the lesson that I'd like you to take away from this week's video, and that's just beware of having preconceived notions about what the market should do, and having personal biases about what you think should be. It's going to cost you very, very dearly. So my strong recommendation is lose the need to be right. Now, I lost that light years ago, as it seems, but it still took me quite a while to learn that lesson. And I think it's the most valuable message that I can give you. It took me a long time. Hopefully I can help you arrive at that point far, far quicker than it did me. And members who followed my recommendations and tactical positioning have done extremely well, and that's certainly flowing through to the newest service as well, which of course is Portfolio Analyst, that you can experience yourself for on a complimentary basis for a couple of weeks. Now, there was a comment, I've certainly had several comments by email, but there was also a comment on this weekly video a couple of weeks ago, which you can go and look at if you wish. And that is around this preconceived idea. And, one particular person was absolutely emphatic that the correction was not over, that the market had to go lower. And it was almost like they wanted or they needed the market to go lower. And that tendency, when you get that fixed idea in your mind, is to ignore the evidence that doesn't support your view. Now, I make various indications through this video about how the market is unfolding and what it looks like. But that's all it is. I'm just calling it as I see it. I don't start with a preconceived idea that the market should go up, down, or sideways. I'm just reporting it as it is. And when you do that and you completely clear your mind of preconceived ideas, then you're actually open to examine all the evidence as it is. And if you can do that, then you're going to be far, far more profitable in the market than otherwise. So that's my very, very strong message this week. The simple fact is, in America, the momentum is higher. That's the long and the short of it. You don't really need to know anything more than that. You can argue that it shouldn't be that way because of Donald Trump, or because you feel that there's an ABC correction that hasn't played out yet, or the valuations are too high, or there's a trade war, or the US deficits, or whatever. There's 100 things you could come up with that would validate why the market should go down. But the fact is the market's going up, and there's just no substitute for playing it as it is, and not what you think it should be. The US dollar still managing to hold that critical support level. It's really just in a sideways pattern at the moment. So let's jump in and have a look at the S&P. We'll start with the big picture first. This is the monthly chart, and you can see we definitely had a wobble in February, but we didn't even make it below the 10 period, which is a 10-month moving average, but we didn't even make it below the 10 period moving average. And you can see how strong March has been already just in a handful of days. So there is no indication at this stage that this market is doing anything other than going through a pause. Now, this doesn't mean that we'll just go straight back up and set new highs. In fact, my belief is at the index level is based on what I see, not on what I believe. But my belief is that this will go sideways for a couple of months longer, because this is the first disturbance to the psychology of the market that we've seen. You've got to go all the way back to here, back to January of 2016 to see that sort of disturbance. And I just don't expect that that's just going to disappear in 1 month. It might, but it may not. But that's at the index level. But I can tell you that there are stocks that are outperforming the index, and there's plenty of them that are setting new highs above the pre-correction highs in early February, and that's where you need to focus your attention. There's the daily chart. So if we put a trend line on where we had been, so there's the trend line through there. That's what we've been running against all through 2017. We got too far ahead of it. We came down below it, and now we're starting to, basically trend back above it again. So you can see the market returned to trend, and now very, very strong lift over the last week. So very, very good signs. Even better signs, of course, coming from the NASDAQ. And the NASDAQ had now set new all-time highs. So it's back above the February highs as an index, which is a very, very positive sign when the NASDAQ is leading in that manner. Let's look at the Russell. Not quite back to its pre-correction highs, but doing every bit as well. In fact, perhaps even a fraction better than the S&P. So that's a good sign as well. When small caps do well, that's probably a lot about the tax reform. When the NASDAQ does well, then the overall market does well. Let's look at the VIX index. So we had a massive spike with that selling in February that was really a lot about leverage. But you can see we've come all the way back down now, and we're back down to 14 on the VIX index. US dollar is still just holding this range here, so there's really been no change. It's just holding between 88.5 and around 90.5. So that's the US market as it stands at the moment. The Aussie market, our dollar rose a little bit, about 0.7 of a cent. Our index was up 34 points on the week, which was 0.6 of a percent. I would expect that we'll have probably a pretty reasonable day on Monday, but we've still got this continuation of the ASX 200 unable to hold above the 6,000 point level and just underperforming so much of the rest of the world. Also in Australia too, I just make the comment that it's far less about sector momentum. In America, you can identify the strongest sectors, the strongest industry groups, and then the strongest stocks within those various sectors and groups. And I do that a lot in Portfolio Analyst. And you can see really strong trends being sustained without a lot of volatility. But in Australia, we seem to get a lot more volatility. It's as though the participants in the Australian market just don't have the courage to stay on board a trend, and there's a lot of very fast profit taking happens. So that means you've got to be very specific about stock selection, and entries are critical because of this trending consistency that we have in Australia compared to America. It's when you look through hundreds and hundreds of charts every day, as I do, it's just so starkly obvious the difference between the consistency of the trend here and in America. So let's just take a quick look at the ASX. So not a lot of movement going on there. We had a plunge during the correction, and we've rebounded, but we're still just holding underneath this 6,000 point level. So really not much happening on the Australian index at this point in time. Turning now to precious metals, gold moved, I think, up a dollar. Not much. It was just pretty much in line with currency movements. And stocks, there's just no change. I mean, this is just a boring sector. Now, there are a couple of really good Australian gold stocks that are doing well. In fact, the Australian gold stocks are outperforming gold stocks around the rest of the world, from what I can see. But outside of that, it's a pretty boring scene. Commodities, copper was up slightly at $3.14. Crude oil also edged higher to be just above $62. Energy stocks not really rebounding at this stage. And the very rapid loss of momentum that we saw, we had a terrific breakout, as you'll see in a minute, and then an equally dramatic loss of momentum is quite a poor short-term indicator. And whilst I think over the medium to longer term, energy has shown enough to indicate that we're forming a base and that higher prices are likely, and that I think we've seen the lows. I don't know when that momentum is going to be regained, and it may not be necessarily in the short term. So let's just take a look then at XLE, which is the US energy ETF. So let's just pan back and get a decent grab. So here were the lows in early 2016, so 2 years ago. We got a rebound, and then it fell apart again. I think you'll find that this is pretty close to a 50% retracement level. Just overran it by a little bit. We then got a very strong move up. As you can see, the energy index moved from the low 60s, got up to the high 70s. And that was quite a steep breakout from this little period of consolidation in here. But you can see just how quickly the energy sector just fell apart again, really quite dramatic. And so now that sector is trying to carve out a base again. It'll have its day, but we're not at that point as yet. So there's the spot copper chart, not much movement, and a little bit of a regain in crude oil. So wrapping it up for this week, stay with the strength. As I explain in detail in Portfolio Analyst, you want to be aligned with the big players. Well, why would you want to do anything else? It's the big players who make the market move. So why wouldn't you hang on their coattails and just follow the momentum that they're creating? And I've said it many times before, but if you can look at the market through the eyes of self-interest of the big players. So if you try and think like a big player would think, and look at what would be in their self-interest, then you get an appreciation that markets move up and have a self-propelling mechanism or a self-propelling momentum, because the institutions are judged so regularly every quarter on their performance that they must continue to outperform the index constantly. And so they're going to continue to stay with the strength. They'll stay with the stocks that are strongest, and because that buying then keeps the stocks as being the strongest stocks. So if you do nothing else other than align yourself with the big players, then you should do pretty well. Portfolio Analyst this week, there's some sector rotation happening all the time. I'm going to review exactly where the strongest sectors are at the moment. There are opportunities all over the place. It's a very exciting period. And if you're not in Portfolio Analyst and you want to give it a trial run, then you can do that. There's a link at the bottom of this video. There's my contact details for those that want to communicate with me, and I'll be back with you next weekend. Cheers.